Welcome back, traders and investors, to the Christmas Eve Day edition of Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your host this morning, Joel Elconin, and I got Nate Tobik on the line, and he is an investor and founder of CompleteBankData.com. Nate, how you doing today?
Good, good, doing well. Thanks for having me on, Joel. Merry Christmas.
Yeah, did you get all your Christmas shopping done?
I did, and thank you, Amazon, for making
Yeah.
that easy.
Yep. And whenever my wife gets out the computer, I'm like, honey, you're not going shopping again, are you? And sure enough. Well, before we get started talking about the markets and interest rates, you got a great site here. Why don't you tell us about your site, what it does, and how people can get good information off it?
Great. Well, so what we have is we put together some tools that really make it easy for investors to gain an edge in bank equity investing. And we do that by pulling a lot of data that's hard to get. And then on top of that, we've built some tools and strategies that give investors insight. So you're not necessarily wading through the data, kind of giving you some of the answers and so you can get straight to trading and making good investments.
Okay. All right. And we're going to do a Fed forecast show after the first of the year. We're going to have Ron and Sana and Peter Schiff and some former Fed participants on. And we're going to talk about interest rates. And when you and I got on the line here, we started to chat, and you talked about interest rates going down. And wow, I mean, that's an interesting take. I mean, everyone's worried about interest rates going up, and now we have Nick Tobik here talking about interest rates not only staying steady but going lower. Let's talk about your thesis.
Right. So I don't know. I don't necessarily have a macro call on where rates are going. I think they will probably stay right around where they are. I know, the consensus is rates are going to be going up, but we've been hearing that for a couple years now, and it hasn't happened yet. And to even go further, in Japan, people have been saying they're going to be going up for the last 20 years. So it's not unfathomable to think that we might be in a low rate environment for a while. And so this is something that concerns banks. And a lot of the headline noise is that interest income has fallen on loan portfolios. And so we put together a short little study recently looking at the interest yield on assets for banks going back to 2004. And so rates peaked in 2007. The average yield on a loan portfolio was about 7%. And now we're about 4.16%. So it's a considerable drop. It's about a 41% drop, I think. And at the same time, though, so while there's a lot of fear in that sort of a headline drop, banks have been able to manage that very well. So they've been paying a lot less on deposits, as we've all experienced, and their net interest margin has only declined 10%. So we had in 2007, actually about 2005 to 2007, banks were earning about 4% is their interest spread. And now the average is 3.68%. So for all the headline fear, banks have been able to manage this environment fairly well. And I think what we've seen is that a lot of the banks that had operations that were inefficient and they weren't flexible, they didn't want to grow, or they had poor lending. A lot of those banks have been cleared out of the market, so to speak, by the FDIC or through mergers and acquisitions. And so, as a whole, the industry is getting a lot healthier, and I think it's very flexible. So, if we continue to have this low rate environment, it seems like banks are going to continue to be profitable and trudge along. Now, they would like higher rates so they could make more money, but I think they're going to do well if what we have stays.
So you're not you do you think all this talk about rates going up, you just think that's hogwash?
I think it is. I think it is, and it remains to be seen. But I've talked to a number of bankers going back a couple years, and they've all been saying just wait a quarter or two, and rates are going to finally go up. They're going to finally go up. And there's a lot of people betting on this, and we haven't seen it yet.
Okay. All right. So how are banks making money in this low interest rate environment? I mean, are they just taking that money from the Fed and investing it, and just, scratching out a little bit of profit there? Are they making loans? Is the housing industry popping up? How are banks making money in this low interest rate environment?
So they're doing it a few ways. The first is they're paying depositors nothing, and so if you look at ads for CDs now, you'll see things where it's like a 5-year CD advertised for a little bit over 1%, and that's considered phenomenal. So they're not paying anything. Most banks have the majority of their deposits, and they're paying out maybe 10 to 20 basis points. So they essentially have free money from depositors, getting free money from the Fed, and then they're able to loan it back out. And so there's enough loan demand. Businesses need loans. People are still buying houses, even though it wasn't at the level that it was in the past. But there's just enough to sustain them. The other thing they're doing is banks have really been embracing technology over the last couple of years because they've realized that it's a lot easier to bring in deposits online, make deposits or make loans online, or really streamline their operations with technology instead of bringing on more people because those people have costs, and it's a lot easier to retire a computer system than let people go. So we've seen some technology advances, and that seems to be propelling them forward. So uh, more efficient operations, very cheap money. And the concern for me really is what happens if rates do go up. Say we get a 2% increase in rates. I'm not sure if the loan demand is going to really be there for banks to make these loans compared to what they need to pay out on deposits.
Okay, let's start talking about some specific banks here. And out of the big banks, your Bank Americas, your Citigroups, your Wells Fargo's, whatnot, what's your favorite one?
So this is something really interesting that we've seen in the valuation universe of banks is that very, very small banks are undervalued and the bigger banks are undervalued as well. So I'm looking, we kind of have this graph of where everything sits. And so look, I mean, Citigroup, Bank of America, and JP Morgan are all, we consider them all relatively undervalued. So they're all trading for less than the index measures of price to earnings and price to book. Wells Fargo is slightly overvalued, and then Goldman Sachs and Morgan Stanley are both sitting on the fence, although I wouldn't consider those classic banks per se. But so the large banks, some of those big ones they're slightly undervalued, and then a lot of the in the middle tier we have that's where I'd say most of the overvaluation is. So these middle tier banks, and there's a lot of excitement around them, a lot of growth in them, and maybe they've run ahead a little bit. And then at the end, the bottom of the market cap structure, you have a lot of small banks that no one's really interested in, and you could find some for extremely low valuation multiples, but you also have to deal with illiquidity and getting in and out.
Yeah, Tim Melvin, we have him on the show frequently. Is there any symbols of some of these smaller banks you'd like to share with us?
Sure. So recently we were looking through banks that are potential acquisition candidates. So a couple that popped up is maybe New Hampshire Thrift Bank shares. I think they have about a hundred some million market cap, and so that's NHTB.
I didn't know the symbol on that one.
Yeah, it's there's dozens of banks like this. Another one might be Astoria Financial AF,
Hmm.
and
I mean, New Hampshire's New Hampshire. Where's AF? Astoria Bank, New York?
I believe so. Yes, yeah,
I don't know how I knew that.
yeah.
Okay. And so that yeah, this one's had a nice bump. How about like your Wells Fargo? What I mean, is it just because they were able to avoid the whole mortgage debacle and the the shenanigans that went on. Do you think that that's what is enabled them to? I mean, not only have they come all the way back, I mean they've been making new all-time highs here pretty consistently. Is that your thesis as well?
Yeah, I think Wells Fargo has won by not losing. And by that, if you had another, if say Bank of America never did their countrywide acquisition, never got involved in some of the stuff they did, I think they would be much higher than they are now, and probably much higher than Wells Fargo. And it's that Wells never, they never dropped, they never did some of the bad things that some of the other banks did, and so they had a higher starting point, I guess, going forward, and so they won by not losing, and that's an important thing when looking at banks is you want to find banks that aren't going to lose. So there were a number of banks with high returns on equity and looked with high growth and looked great right before the crisis, and um, those returns were all fueled by bad loans, and we get a bad economic environment, and those things went out of business. So there's some wisdom in finding investments that maybe won't crush the market, but also aren't going to go into receivership in a bad environment, and so you win by not losing.
Let's talk about that Bank America, takeover countrywide, and I'll give you my theory, and then you can comment on it. But to me, I mean, there was just no reason for them to buy the company. I mean, it was the president, everyone was resigning. It was obviously what was going on. They were in all kinds of trouble. And to me, I think the only reason they did it is because, they figured, they were going it was going down with the ship, and if they acquired the company, they could kind of sweep as much under the rug as possible, as opposed to just letting it go, completely go to zero. Am I off base on that?
No, I don't think so at all. I mean, I think there was some hubris there on Bank of America's part. I think part of it was I could almost envision some executives sitting around saying, "This can't really be as bad as people think it's going to be. I'm sure it'll work out better." And it didn't. It didn't, and they took the hit for that.
Yeah, they did. So let's just talk about a couple of the big guns here. Goldman Sachs has made a nice run here. Seems to be running into some resistance. Really, the last leg of the market has been led a lot by the financials. Just crazy week last week. We're back up here. Is it time to maybe take some profits here on this Goldman Sachs and the Morgan Stanley, or do you see continued upside for them?
Yeah, I mean, if someone's sitting with a big gain, I would definitely take some off right here. I think what's gonna an earlier guest was talking about the computerized trading and how that's changing the market. And what's interesting is guys like Goldman Sachs and Morgan Stanley, they're huge players in that, and so they I don't want to say they have the perpetual money machine, but they've almost perfected this machine where no matter what the market's doing, they're always going to make money because they're taking a cut of every trade and they're ahead of every investor. And so, um, that's a huge advantage. And until something structurally changes with the market, I think they're going to continue to milk that. And so I would say, yeah, they've run up with the market. If you're sitting on a gain, it's probably worth reconsidering for the new year. We don't know what's going to happen, but they're interesting creations for sure.
Yeah, I just finished the Flash Boys, and reading that book, and the thing that really stands out to me when you talk about these HFT firms and the big boys, the fact that they never have a losing day. I mean, that's just not fair. I mean, if you never have a losing day, then you must have an advantage because from investing and also from trading. I mean, that's nearly impossible to happen, but it does. So to me, that's the biggest red light that is out there. I mean, man, at least take a lot or scratch or something. But
Yes.
they
Yep.
also have very low commissions. Just want to ask you too. I mean, they're not really banks, but you know, brokerage firms, the brokerage houses, and I'm talking about the discount brokers, like TD Ameritrade. I mean, they do have some banking functions, don't they?
Some, yes. Some of them are brokers with a bank bolted on. I know E-Trade is like that or was like that, and they got into some trouble because they didn't quite understand what their bank was doing. They took a lot of losses on their home equity loans. But so brokers are usually a good business. Another great business to look into that's tangential to this is asset managers. And asset managers are an incredible business. There's one I really like. It's Senvest. It's a Canadian company, and let me get the ticker.
Dennis is you probably perking his ears up there with mention a Canadian company. Yeah, that just
Yeah,
uh,
it's SEC dot Canada, or in the U.S. there's a pink sheet SVCTF, and so what you're getting with them is you're able to buy into the manager, and I think this is at maybe like 60 to 70% of book value right now. So you're getting this manager at a discount, you get their fee stream, but they have a big position in a lot of their own hedge funds. And so you're able to buy into these hedge funds at a discount, and they've trounced the market. I don't have the numbers in front of me right now, but they've done really well. There was a Bloomberg article about them recently, and these managers are flying under the radar. They beat the market. So you could buy into a market beating hedge fund at a discount and get some of that fee stream. So instead of paying a manager to manage the money, you actually, get a little kickback there.
yeah, that's nice. What was the pink sheet symbol again?
It was SVCTF.
Okay, let me see if that. There it is. Yeah, it did come up a little bit expensive. $127. Let's see if we can get something from a day. It trades by appointment only. There it seems so. Something to keep an eye on now. Final thoughts on the market for heading out 2014 and looking into 2015.
Yeah, I mean, so banks have been relatively flat in 2014, and we don't know where they're going to go in 2015. But I know that the M&A market is starting to heat up, and so a lot of these undervalued banks are kind of having their day in the sun. I know what I've seen with a lot of banks is they're what I'd consider one-day stocks. So you might own this thing, and for 2 or 3 years, it trades between say 13 and 15, and then one day it gets a buyout for 22. And so all the gains are made at once. And for the investor who's patient and waits, that it's a profitable trade.
Okay, Nate Tobik, investor and founder of CompleteBankData.com. He joins us here on Benzinga's Pre-Market Prep, brought to you by Markify every couple months, and we certainly enjoy our conversation with him. Have a great day. Have a great holiday, Nate, and we'll talk to you after the first of the year.
All right, thanks. Merry Christmas. Thanks for having me on.